All right. Welcome back to the deep dive. We're ready to take another deep dive.
Absolutely.
And this time we're going to be putting on our business analyst hats, right?
Okay.
You sent over a document.
Yeah.
And it's a lot of information.
Lots to unpack there.
There is a lot to unpack. Today we're going to be focusing on pages 15 through 23.
Okay.
And we're going to be looking specifically at Dollar General.
Yeah.
So what we want to do today is, the goal is to kind of get through all of that.
Yeah.
And really come away with, we want to come away with the most important stuff, the main takeaways.
Yeah, the insights.
The insights, about their business, how it's doing now, and maybe even get a sense of, where things might be going. And we're going to be basing everything on these pages of the document, which you were kind enough to send over to us.
Okay. So first things first, when we look at Dollar General as business analysts, what's the thing that really jumps out at us? Well, I think when you get to page 18 and you start looking at the overview of their business in late 2024, the scale of Dollar General really kind of hits you. They are the largest retailer in the U.S. by store count, 20,363 stores, supported by a huge distribution network of 33 distribution centers.
Wow.
Just to compare that, Dollar Tree, which is probably their closest peer, the second largest, but they only have over 16,000 stores.
Right.
So, and even when you compare them to, the big guys like Walmart, which is roughly 5,200 stores in the U.S., or Costco, which is about 900 warehouses.
Yeah.
The sheer footprint of Dollar General is pretty remarkable.
It's hard to even imagine, like over 20,000 stores. That's a lot of stores. Yeah. And it seems like, I was looking at page 18 here, it seems like they've been very intentional about where they're putting those stores, right?
Yeah, definitely.
Like 80% of their stores are in towns with populations of 20,000 or fewer.
Yeah, that's a pretty significant rural focus.
Yeah.
And it's up from, about 70% back in 2016.
So they're going even more rural, it seems like.
Yeah, it seems like they're doubling down on that strategy.
So, from a business analyst perspective, why? Why focus so heavily on these smaller communities?
Well, I think as an analyst, you've got to look at that and say, well, one of the things they're doing there is carving out a pretty good competitive advantage.
Right.
And it's not just that there's probably less direct brick and mortar competition in a lot of these towns,
right,
but it's also, these smaller store formats, they just make more sense in a lot of these places. It's
right,
less upfront investment, probably lower operating costs in, less densely populated areas.
Right.
And then the other thing is, if you look at what it says on page 18, in a lot of these communities, Dollar General is actually kind of a primary, sometimes the only place for people to get those basic consumable items, during the week.
Yeah.
They may make bigger shopping trips on the weekend, but Dollar General is there kind of meeting those frequent needs, those immediate needs, in between those bigger shopping trips.
Yeah. Makes a lot of sense.
So that convenience creates kind of a really sticky customer base.
Yeah, absolutely. So let's look at their pricing strategy for a second. So if you look on page 18, it talks about how they're priced slightly higher than Walmart, like about 1.5%.
Yeah.
But significantly lower than convenience or drugstores, like between 20 and 40% lower.
Yeah.
So how important would you say, as a business analyst, that this pricing sweet spot is to their overall strategy?
I think that's a really key observation. When you look at them from an analyst's perspective, I think this sort of multi-tiered pricing is really core to their value proposition. They're not trying to be just the absolute cheapest on everything. You see that in that slight premium to Walmart.
Right.
But they're positioning themselves to be a lot more affordable than those, immediate need channels like those convenience and drugstores.
Yeah.
So what this lets them do is really kind of capture a certain kind of customer, right? Somebody that wants affordability and accessibility, but they don't have to be just the rock bottom lowest price on everything, right? So they're not getting into these price wars at the very bottom of the market. It's more about offering value for the convenience that they provide, and particularly in those underserved rural markets.
Makes sense, yeah. Okay, so let's take a step back for a minute and look at some of the history here. So if you go to page 19, It talks about an investment in Dollar General that was made back in 2016. It talks about the reasons why Dollar General was favored over Dollar Tree Family Dollar. It mentions the CEO, Todd Vassos, and some of his talents. It talks about how much they were spending on expanding and remodeling stores before the pandemic, which is really interesting. But then it brings up this idea, this concept of Dollar General's contra-economic sensitivity. Can you explain what that means? And I think what would also be really helpful for listeners is how did the pandemic impact Dollar General through this lens of contra-economic sensitivity?
Yeah, so contra-economic sensitivity, I guess in simple terms, it just means that the business actually tends to do better when the economy is struggling. And it might not do as well when the economy is strong. So if you look on page 19, it specifically says that Dollar General has historically been weakest at economic peaks and strongest during recessions.
Okay, interesting.
But then the pandemic comes along, right, and the pandemic created this really unusual situation.
Yeah.
At first, when all those stimulus payments went out and, people were changing their buying habits, Dollar General actually got a boost.
Okay.
But it wasn't a typical recession, you know what I mean?
Right.
But then as that sort of, free money started to dry up, savings for lower income households, they went away. Cost of living started rising faster than wages, right, and their core customer really started feeling the squeeze.
Yeah.
And so then you had this issue where they had too much discretionary merchandise, stuff that people just weren't buying as much anymore.
Yeah.
And so Dollar General had to start discounting.
Yeah.
So it was kind of this weird disruption to that typical pattern of how they perform, in relation to the economy.
Yeah, it's like the pandemic really threw like a wrench in the works, right?
Yeah, exactly.
For that. Okay, so let's go to page 20 now, because this is where the document starts talking about what it calls unforced errors in how they were allocating capital. And they're specifically looking at the huge increase in share buybacks that happened during and right after the pandemic. Could you sort of walk us through how analysts are critiquing these decisions?
So this is a really an important area for analysts to look at. The document, it talks about how this guy, Bill Rhodes, the former CEO of AutoZone, really shaped Dollar General's capital allocation strategy after their IPO. And the basic idea was good, focus on things with a high return on capital,
yeah,
reinvest in the business to grow it, and then return any extra cash to shareholders, through dividends and share buybacks. And if you look at page 20, it actually says that Dollar General managed to, lower their share count by a pretty significant amount, like 36% from 2012 to the end of fiscal year 2023. And a lot of those buybacks happened at prices that seem pretty reasonable now, considering what they were like before the pandemic.
Yeah.
But the big criticism is that management really ramped up the buybacks to over $2.5 billion a year.
Wow.
And they did it right when their cash flow was kind of artificially high because of the pandemic. And also, their stock price, you could argue, was probably higher than it should have been at that time.
Okay.
So what the document's saying is that this led to a pretty big jump in their debt. It went from $2.9 billion before the pandemic to $7 billion by January 2023. So basically, they were taking on more debt to buy back shares at a time when, those shares might have been overpriced.
Yeah.
So it makes you wonder, about the timing of those decisions and how disciplined they really were with allocating their capital.
Yeah. So it's not just what you do with the money; it's also when you do it.
Yeah, absolutely.
Okay. So let's talk about the stores themselves for a second. So on page 21, it talks about how they're trying to make their stores bigger, on average, and they're adding more cooler space.
Yeah.
But it also mentions that they seem to have fallen behind on keeping up with maintenance on a lot of their stores, as they've been opening so many new ones.
Yeah. Yeah, that's right.
So what's the situation there now? And what are they planning to do operationally to get things, back on track?
So it's interesting because, as they've just rapidly expanded their stores, they're over 20,000 now. It seems like they haven't really kept up with the remodeling and the regular maintenance.
Yeah.
Like they used to remodel about 1,000 stores a year.
Right.
When they had, fewer stores.
Yeah.
But now that they've got so many, it's clear that that just wasn't enough.
Right.
So if you look at page 21, it says that they're planning to do a whopping 4,250 store remodels or relocations in fiscal year 2025.
Yeah.
That's like 21% of all their stores.
Yeah.
And they're cutting back on new store openings to 575.
Okay.
So what they're doing is shifting gears to really focus on reinvesting in their existing stores and upgrading them.
Right.
And so, from a business analyst's perspective, the idea is that, having these modernized stores will make them more attractive,
Right.
get more people in the door,
Right.
and it'll boost sales, especially for higher margin stuff like refrigerated goods.
Okay.
And, ultimately that'll lead to better profitability over time.
So they're basically kind of like taking a pause.
Yeah, you could say that.
From just opening new stores.
Yeah.
And they're focusing on what they already have.
Yeah, exactly.
Okay. Page 21 also mentions, briefly that they're having some issues with labor and distribution.
Yeah.
And it doesn't go into detail, but I think it'd be helpful to talk about just in general, what are some of the challenges that a retailer as big as Dollar General faces in those areas?
Well, I mean, when you've got, over 20,000 stores, managing all of those employees it's a big job.
Yeah.
It's everything from making sure that you've got enough people working at each store, offering competitive wages to training them, giving them benefits, and making sure that that they stay with the company.
Right.
If you're not efficient or if your costs go up in that area, it can really hit your bottom line hard. And then on the distribution side, they've got 33 distribution centers, that are supplying all these stores.
Right.
And keeping that whole supply chain running smoothly and affordably is super important.
Yeah.
Things like transportation costs, warehouse labor, inventory management, they all matter.
Yeah.
And any problems, or rising costs in that distribution network can quickly impact the whole company.
Right. Right. So these are areas where retailers are always trying to find ways to do things better.
Yeah.
But they're also, very much affected by things that are happening in the economy, right?
Absolutely.
So how's all of this affecting their financial performance?
Right.
So if we go to pages 22 and 23, it talks about how their margins are under pressure.
Yeah.
And it really goes into what that might mean for the future.
Yeah.
And it seems like the analysis is saying that it's unlikely that they'll get back to the profit margins they had before the pandemic.
Yeah. Yeah.
So what are the main reasons for this pressure? And what kind of trends are we seeing in their margins?
So page 22 really lays out how their margins have been squeezed. So before the pandemic, they were operating with margins of around 9.5%. Oh. And then during the pandemic, they actually jumped up to 10.5%, which, was probably not sustainable.
Right.
But now they're estimating that for the fiscal year ending January 31st, 2025, their operating margin is going to drop to about 4.7%.
Wow.
And their net margins are following a similar trend. So from 5.5% pre-pandemic to a peak of 8% down to a potential 3.1%.
Okay.
So this shrinking margin is mainly because of, a few things. Labor costs are up across all their stores.
Yeah.
The store maintenance and the remodels we talked about are costing more.
Right.
And they're selling more consumable goods, which have lower margins. So there are a few things they can do to try to improve their margins from these lower levels.
Okay.
Like they could try to get more shoppers into those bigger remodeled stores.
Right.
They could reduce how much discounting they do and how much inventory they lose.
Okay.
They could make their distribution network more efficient.
Right.
They could narrow down their products, to just the best sellers.
Okay.
And they could try to just create a better overall shopping experience for their customers.
So it sounds like, things are tough on the margin front right now.
Yeah.
But they do have some options.
Yeah, sure.
All right, let's talk about their growth potential. So on page 22, it talks about their long-term growth plan. and their sales projections.
Yeah.
And it says their long-term goal is to have at least 30,000 stores.
Wow.
So how does that ambition, how does it fit with what they're focused on strategically right now?
So while they still have that long-term goal of, 30,000 stores, their immediate focus, like we were talking about, is really on making their current stores better.
Right.
But page 22 still projects pretty significant square footage growth, between 5 and 6.5% each year.
Okay.
And they expect this to come from a few things, opening new stores that are bigger than their older ones.
Right.
Finishing those remodels, which also often make the stores bigger.
Yeah.
And then just natural sales growth from their existing stores.
Okay.
And the analysis suggests that even if their same-store sales just keep up with inflation, they could still grow their overall sales by 6.5% to 8.5% a year for the next 5 to 10 years.
Wow.
And even if you look at, some of their more conservative projections, they're still talking about sales growing at about 5% per year.
Yeah.
So yeah, they might be opening fewer new stores in the short term.
Right.
But their growth story isn't over.
Okay, so it's just shifting, a little bit.
Yeah.
Okay, so let's talk about how they're planning to give value back to their shareholders.
So on page 23, it says that they've stopped doing share buybacks for now, but they plan to start again at some point. So thinking about what we discussed earlier about their buyback strategy, what are some things that analysts are looking at when thinking about how they might handle buybacks in the future?
So I think analysts are looking for them to be more careful, more disciplined with their buybacks this time around.
Okay.
Specifically, they want them to wait until they've paid down a lot of their debt.
Yeah.
And until they've finished those big store maintenance and remodeling projects.
Okay.
That'll put them in a much better financial position.
Right.
And, if they start buying back shares when the price is low, which it is right now,
Right.
then they'll be using their capital more effectively.
And if you look at page 23, it gives some projections for their net margins. So in their base case, they're looking at about 4.5%.
Right.
And in their bear case, which is, more pessimistic, they're looking at about 3.5%.
Okay.
So both of these are lower than what they were doing before the pandemic.
Right.
But even with these more conservative estimates, the stock is currently trading at about 13 times earnings based on that lower 3.1% net margin estimate. So it seems like it might be undervalued.
Okay.
And then the other thing is, their dividend yield looks pretty attractive at this valuation.
Right.
So, if their margins recover and investors feel better about the company, their price to earnings multiple could go up to, 15 to 20 times earnings.
Okay. So there's potential for upside.
Yeah. There's definitely potential.
So even with all the challenges, page 23 lays out, some pretty good scenarios for investors in terms of potential returns.
Sure.
Could you give us a quick rundown of what those might look like?
So if you use some, I think they're pretty reasonable assumptions about their future profits and growth. The base case scenario shows a total return of 257.9% over time, which works out to an average annual return of 29.1%.
Wow.
And even the bear case, which is, the more pessimistic one, still has them more than doubling their investment with a total return of 114.5% or 16.5% per year.
Okay.
And it's worth pointing out that even in the base case, the stock price would only go back to about 90% of what it was at its peak in 2022.
Yeah.
So it's not like they're assuming some crazy rebound or anything.
Right.
These are pretty grounded projections.
Right. I mean, those are some pretty impressive potential returns.
Yeah.
But of course, there's always risk with any investment. And page 23 goes over some of the key risks and things that investors should consider.
Right.
So what are some of the main concerns that the document highlights?
So there are a few important risks that they point out. The biggest one is, what if their core customers, those lower income shoppers, what if they just don't recover from inflation?
Right.
Programs like SNAP and other government benefits, they might help a bit.
Yeah.
But the analysis says, don't count on it too much.
Right.
There's also the risk that, maybe they can't open as many stores as they think they can in the long term.
Yeah.
And they also have to watch out for new stores taking sales away from existing ones.
Right. Cannibalization.
Yeah, exactly. They also talk about how, as Dollar General moves west, their costs might go up because they'll have to ship things farther.
Okay.
And they won't have as many stores concentrated in each area. Right. And then another thing they mention is that, the way Dollar General has reported their returns on equity and capital in the past might actually be a bit misleading.
Okay.
Because of those buybacks they did at prices that were higher than the company's book value.
Yeah.
So the point is that it's really important to look at how much profit they're making on each new store they open or on their existing stores.
Right.
And they also raise the concern that if their net profit margins stay really low, the business might not actually be earning enough to cover its cost of capital, even if it's showing a profit on paper.
Yeah, that's a good point. Okay, so despite all these risks, the overall tone on page 24 seems pretty optimistic.
Yeah.
It's almost like it's taking a contrarian view.
Yeah. I mean, it is.
So what's the final takeaway? Like, what do they think about Dollar General's prospects, based on all of this?
So they are optimistic, and not just about Dollar General, but about Dollar Tree as well, their competitor. They say that, both companies are dealing with similar problems right now, and that's probably going to mean their profits won't be as high as they were a few years ago.
Right.
But they still think the fundamentals are good,
Okay.
They've got a strong presence in the market. They can keep growing, and they can still make decent margins.
Yeah.
And then there's this interesting idea of, what they call an embedded call option on a strengthening consumer.
Okay.
So what that means is that if the economy improves and their customers start doing better, then that could really help their business.
Right.
And I think the most interesting point, the final point they make on page 24, is that the stock market is basically acting like Dollar General is, a broken business.
Yeah.
And historically, these times when everyone thinks a business is in trouble have often been good times to invest.
Right.
Because the market hasn't recognized, the underlying value and the potential for a turnaround.
Yeah, so they're saying maybe now is a good time to buy.
Yeah, potentially. I mean, obviously, you have to do your own research and all that. But...
Yeah, of course. Okay, so to kind of sum everything up here, so Dollar General is they're facing some pressure on their margins.
Yep.
And they've got some operational things they're working through.
Right.
But they're also huge.
Yeah.
They've got a strong position in these rural markets. And they have the potential to, turn things around and keep growing.
Right.
And from a business analyst point of view, it seems like the market might be undervaluing them right now.
Yeah, I mean, that's what it looks like.
And if management can, get things moving in the right direction and the economy picks up, there could be a pretty good opportunity here.
Definitely could do.
Okay. Well, this has been a really interesting look at Dollar General, from a business analyst's point of view.
Yeah.
And it's been really great, getting into the details.
It has.
And talking about, the potential opportunities and risks in the discount retail sector right now.
Yeah.
So that brings us to the end of our deep dive into this document.
Absolutely.
And now, for all of you listening, we've talked about a lot of things here.
We have.
So I want to leave you with this. What do you think will be the biggest thing that will help or hurt Dollar General in the next few years?
Yeah, that's a good question.
Or, how does what Dollar General is doing, their strategy to succeed in this economy?
Yeah.
How does that line up with how you think about where the real value is in retail today?
Yeah, I think those are questions worth thinking about.
We encourage you to take what we talked about today, do your own research, and keep an eye on Dollar General and the retail sector in general. So thanks for joining us for this deep dive. We'll see you next time.